Hi, I'm Cody from Wall Street Breakdown. We get into a lot of stuff on this channel in regards to people getting started with investing. The big concern I see with most people is it feels like you're entering kind of a foreign land. You don't know a whole lot of the territory as it is. And on top of not knowing the territory, the lay of the land, you don't understand the language. The language is such a big barrier. You go on to any kind of financial news media, whether it be you reading a Wall Street Journal or you're watching CNBC, you're going to hear or read words continuously throughout sentences that throw you off. And you go, what? And it can be so frustrating because you almost feel like you're being boxed out. Now, the fact is that because this industry is something that a lot of people would like to get into as a hobby, as opposed to, say, being an architect or an electrician, you're probably going to find a lot more stock hobbyists than hobbyists of electricians. You're going to have the same kind of barriers to entry. There's going to be these jargon issues. Anthony's going to let us know, Lingo is our big barrier to entry at first because it makes us feel like we're dumb and we don't want to ask for help, and we have to stop every sentence because we read a sentence really fast and go to the next one, and then we realize we're not processing this, we're just reading it. We understand the words, but we don't understand how these words in this context or in these phrases are usable in this marketplace so that we can read and retain on a nice, even level so that this stuff becomes very, very easy. So we're going to look at some jargon. We're going to go over this over the course of 5, 6, 7 videos. Who knows how long this is going to be. And we're not going to do this introduction every time. We are just going to jump right into it. So for today, we are covering the absolute easiest stuff. Bull or bullish. You're going to hear this word out there. To be bull or bullish on something, to be bullish on the market, means that you're positive. You think the market is going to be going upwards, in an upwards trajectory for a period of time. It means you have optimism about the way things are going. If you hear someone referred to as a bull, if you hear that there's bullish sentiment, the feeling is bullish, then you're hearing that people are feeling like the market has steam to go upwards. To the contrary of that, bearish or bear sentiment is the opposite of bullish. It means that people are very trepidatious. They're wondering if the market may not pause or take a bit of a pull back. So if you hear that people in the marketplace, or that the marketplace as a whole, when you're watching financial news or reading something really quick, bull, positive, bear, negative, that means people are pulling back. Bear doesn't necessarily mean negative. You could be a short seller and be doing just fine in a bear market, but bear in and of itself means the market as a whole. The idea is that the market may be pulling back. There's bull, bear. A contrarian, something you're going to see in the financial news media all the time, is people arguing a popular opinion. I actually do the same thing. I find that a lot of times the news media can kind of get things churning and they feed into a bunch of things. You have a bunch of analysts come on, and over the course of weeks, they drum up topics that they put a lot more steam behind than the actual topic itself has steam behind. The media does that. So you'll find people, myself included, that'll find themselves on the opposite side of the fence. A contrarian, someone who at the time might be kind of laughed at or looked at as if they're a little silly, or that their ideals don't really play out in the practical world. But the fact of the matter is a lot of contrarians end up being very right. It just is very difficult to find yourself being the one that's taking a stance kind of alone, right? When the masses are over here telling you that they love things the way that they are, that things the way they are for sure this way, and you say, I just don't believe that, I'm going to go the opposite way of things, you become a bit of an albatross. But a contrarian is definitely a word you're going to hear thrown around because it is used predominantly in the stock market, because you have people come out and call big shots. Guys got big nuts. They let that stuff swing. They got a lot of money. People are not afraid to go out there and do things against the grain. So a contrarian is something that you're going to hear when you see that word thrown around. Know that you're probably looking at someone or reading about someone or a company that's going against what the norm says right now is the way to do things. An analyst, you're going to see lots of these people on the news. You're going to hear it referenced when we're talking about earnings per share or revenue. You're going to always hear there was a analyst estimate. So analysts work at different banks, investment investment firms. These guys are hired to break down companies, break down sectors, do all sorts of work, make all sorts of projections on where things are going. So you're going to see analysts constantly television. They're going to be making quotes. You're going to see analysts upgrades and downgrades at banks and all sorts of stuff. Analyst basically is someone in some capacity somewhere doing research and making a well knowledgeable, but not obviously prophetic. They're not going to be able to predict the future. Call on where they think this company or a sector is specifically going in a specific period of time. So you're going to see analysts. There's all sorts of them. They specialize in all sorts of things. They are represented as all sorts of different banks and everything else. You'll see analysts from ratings agencies, from all sorts of places. Don't get too caught up in any one analyst or any one company that gives analytics. It's not that important. You're going to see, obviously, a lot of the times, analysts are going to be fairly comparable with other analysts. If 18 people are covering Walmart, you're going to find most analysts are in kind of the same range because a lot of the information is available. When you get down to a company where only one or two analysts are covering it, you might find a lot more discrepancy in what people are saying might be the predictable future. But an analyst, nonetheless, someone making a prediction based on some research, working for somebody. So could they be pushing a bit of an agenda? It's always a possibility. What's a stock? So we're talking about what these people do. We're bullish on stocks, we're bearish on stocks. We've got contrarians saying don't buy this or buy this, despite what the market says. We've got analysts telling you what's good, what's bad. What's a stock, Cody? A stock is basically a piece of equity. Equity was issued by this company so that they could raise some capital. This equity's out in the marketplace, able to be sold, bought, sold at whatever price people deem is fair. And it's you owning a little piece of that company. You actually physically own a little percentage, nominal amount of equity in that company. It's not like a bond where you own debt, where, I mean, if a company went insolvent, you became obviously somebody who get paid out a lot quicker than a shareholder would, but a shareholder actually owns a piece of that company. You can feel like you and that company are kind of working together, which is why I think stocks are the most rewarding, because you are picking things that you really believe in, that they're going to win, and you are in theory kind of compiling it with a basket of stocks that you are purchasing, a portfolio, your projection of the future of industries and where you think things are going. And people obviously with good projections of where things are going in a bunch of industries end up doing fairly well in the stock market. So a stock is just that. It's a share or a stock of a piece of equity in a company. Very, very simple, but people wonder, well, what is that? What a share, stock, the same thing. Don't get confused by the jargon, right? You don't want to get confused. Don't get boxed out. I know people, they feel like they're being boxed out when they look at a lot of these television channels, they listen to a lot of the podcasts, they even hear me speak and they go like, man, you go on a tangent and you don't let us know what you're talking about, and eventually you lose me. I'm going to try to go through this, but I do understand you can feel like you're being a little bit cock-blocked by a lot of these places, right? They don't teach it to you in school, and then you get to these venues, this media outlets where they try to give you the news as if it's relevant, and it is. Let me tell you, these publicly traded companies, they take over they're everything in the entire world. I mean, that's where all the money is. So you need to know this stuff. This is prudent to know for living in the first world and investing any type of money. I mean, this is prudent if you're looking to make any type of headway in life. But the issue is you go to these media places and they don't teach you anything. They just are off to the races. And that makes people very standoffish. So when you hear something like a stock and a share are the same thing and it's just equity in a company, it's, man, that's really basic. But you know, you get people throwing 50 things around that are all words and phrases that you don't use in your day-to-day life. You can feel really, really, taken aback by that. It doesn't make it very inviting. It makes you feel like you're kind of, a bit of an albatross. You don't fit in with this. You do. We can get over this together. So what's a sector? You're buying stocks. You need to diversify. We know what diversification is, right? Okay, let's just get into diversification. What's diversification? First off, diversification is making sure that you have separated things properly. You don't want too much stuff touching too many things, because when too many investments overlap with other potential investments, whether it become from their suppliers or the companies that they use to distribute things, or that they're all involved heavily in fuel charges or whatever any of this is, Our big issue is that diversification needs to make sure that a lot of things aren't overlap. So if markets go down, it doesn't drag everything down with it. There's diversification, very simple. What's a sector? We're obviously breaking down companies into what they do. A lot of companies cross into multiple sectors. You're going to get companies like Siemens or 3M or GE that are going to cross into multitudes of different sectors. You're going to have to look at that on a much more broke down basis. But sectors, in a nutshell, are very simple. Aerospace, companies that make airplanes, right? So we're talking Bombardier, Airbus, Boeing, Lockheed Martin. But then when you start talking defense contractors, you then can also lump companies like Boeing and Lockheed Martin in with a Northrop Grumman and a Raytheon. So this kind of stuff separates companies based on what they do and the magnitude that they do it. They do cross over into a few other sectors, but sectors for the most part laid out through the S&P are a nice conglomeration of companies that have a lot of similarities. And when similarities through consolidation in a marketplace start to take hold, like we're seeing in telecom and media, where AT&T, Verizon, Sprint, T-Mobile, this is going to be an area where people who are providers of data and signal and all this kind of stuff start to meld with cable providers. I'm getting off a little bit on this, but the reason we need to know is because these sectors are going to be mixed together here come the end of 2018 by the S&P, the media and telecom sectors, because they're becoming so much alike that they're very difficult to discern from. So we want to watch sectors, very easy. What do? Are they big pharma? Is it Bristol Myers Squibb? Is it Merck? Is it GlaxoSmithKline, Johnson & Johnson? You're talking about big pharma, right? So there you go. You're talking about a sector, what that sector specifically does. Volatility. What's volatility in the marketplace? That is how volatile, just like the word says, the market is acting. So we have a volatility index, the VIX, that people follow, that basically gives a general roundabout idea and a nice averaging, because you can take a look back at how things were and how things are now. That'll give you volatility, how much things are moving, how much companies are being sold outside of their volume ranges, like, because everything's on averages, right? So volatility is something that affects the marketplace on a daily basis with every different major catalyst and even minor catalysts sometimes that can move even just minor sectors. So volatility constantly bouncing around, but it's something like anything else. It's like being in traffic. Traffic has volatility. It's not something you need to overread in. As long as you're paying attention to the market as an overlay and you understand the economy and where the market's heading, unless you're going to play the volatility index specifically, volatility is going to be something that's going to be there. Things go up, things go down, and your money's on the line. Expect volatility. What's an IPO? How does a company actually get public? How do you get there going public? What does that mean, public? Public means your company has shares of equity available for sale. That's what going public is. How do you go public? You have an initial public offering, which is you originally selling the shares out. Underwriters price that out. Companies, big banks and stuff, purchase large allotments of these shares at the set price and then put these shares for sale on the next marketplace. Now, don't get confused. Companies do not IPO, initial public offering, like a company like Spotify this year that's doing that, or Dropbox here in 2018, depending on when you're watching this video. They're not going to take this right to the marketplace that you would purchase stocks on that you think of when you set up your TD Ameritrade account and start buying it. An IPO sells it to places that sell it out on a much bigger scale, that hold on to it and sell it out in volume. But they purchase it through the prospectus at the offering price, the asking price at the beginning of the IPO. Right before it goes public, we then find it onto an exchange. Now that's where you're going to be purchasing it, the exchange, more times than not, as you're not probably going to be buying a lot of IPOs. You might be. I mean, you can get into that market, but definitely more times than not, when people are purchasing stock, they're buying it on the secondary market through an exchange, the Toronto Stock Exchange, the NYSE, the Nasdaq, the Chicago Mercantile Exchange, if you're purchasing commodity futures. There are exchanges all over the place, and this is where companies are listed. They choose what exchange they want to be listed on. Then they take that company public when you and other investment banks and retail clients and everybody else out there are trading shares around over the course of X number of years, that is the secondary market taking place on these exchanges. Finally, what is an index? An index very easily can get confused with an exchange, but an index is not. An index is a weighted average of companies. That's something that gives people a barometer of how things are doing. So you could take the Willshire 5000 and look at almost every publicly traded American company that's listed on every exchange, or you could narrow it down significantly and look at companies that are at the very top end of American industry, like the Dow Industrial 30. You can also take the top 500 companies listed, the S&P Standards & Poor 500, probably the most followed and probably most traded index that's out there. The S&P 500 takes companies from the New York Stock Exchange and the Nasdaq and puts together the 500 of the best, but these are indexes. These are not the actual exchanges. Listed on the exchange, NYSE, TSX, and the Nasdaq, indexes created on a bit of a different level, created to basket things together, created as a bit of a weighting tool of how companies or sectors or industries are doing. So these things very much easy to understand when you look at them. When you hear this kind of stuff, we want this to be able to breeze by. We don't want this to be something that you get caught up with. This is the easy stuff. We're going to keep covering the easy stuff. I'm just going to hammer some examples out, give you this stuff. Anthony's going to be just continuing to put this stuff over here. And we're going to make it so that when you turn this stuff on, this becomes a breeze. And we don't have to worry about this anymore because we want you to be able to get to the actual information, process that. So once this becomes muscle memory and you know all these words and phrases, and as soon as they come in, you just process, go boom, I know exactly what you're talking about. Then we can get the actual information in there, and then you become a better investor. I'm Cody from Wall Street Breakdown. We are going to continue to come back with more and more of these jargon videos until I feel like I'm pretty satiated with it, and I've given you enough of the information that we can move on to a new topic. There it is. That was the absolute bare bones. We talked about bull, bear, stock. We talked about sectors. That was the absolute surface of things. But we're going to get down to the nuts and bolts, and we're going to make sure that we make you an outstanding investor, and we want you to have an outstanding rest of your day.